Hey, I'm Ben from Modern Gram, and today we are going to do a Modern Gram valuation of HP Inc. So be sure to stick around to see what I think of this company. Now, we've got HP Inc. is the company name, of course, and the ticker is HPQ. The current price is $29.53. The sector is technology, and the industry is hardware. Then when we come down here, we can see the things that I find most important on the balance sheet. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and outstanding shares. And you can see all of those numbers here. And then let's take a look at earnings. So earnings, actually, let's come over here and look at this handy chart where we can see the earnings have been in blue here. They are going up, and then they hit a fall during the initial tech boom bust, and then they rose up again and then hit a crash again in the Great Recession, and since then they've been relatively steady. Let's look at some of the details here, and again you can see we had a negative earnings here in 2002 and again in 2012, but since then we have been on the way up for the most part. Here we can see earnings per share Modern Gram. That is a normalized version of the earnings. We take a weighted average of the last 5 years, putting the most weight on the current year and the least weight on 5 years ago. And with that, we can see it's intended to smooth out some of the business cycle. So you can see the overall trend. And you can see a little bit that, they had a big dip in 2012, and that is reflected in the diluted earnings, but in the normalized earnings, it wasn't quite as extreme. But then again, on the upside, in 2021, they had a big jump in earnings, probably as people were buying home printers and things like that for working from home. But although I don't know what you would need a home printer for when you're working from home and not going into the office at all. But anyway, I digress. What we have here is the normalized earnings kind of not quite being as extreme there. And so you can see that has been on the rise for the most part, which is a very good thing for the valuation. Looking at dividends, you can see that dividend has been very consistent, and that's reflected here on the chart too. Red, it has been steady, and that is one thing we love to see is steady dividends, and for the most part steady dividend growth, but not consistent over time. They did freeze it for a long time after that tech bubble burst. And so they froze that and did not grow that dividend, but they continued to pay it, which is very good. Dividend payout ratio has been between 20 and 30% for the last decade. So it has been pretty steady. And dividend yield has been in the 3 to 5% range for the most part, and there as well, which is a pretty good dividend, I think. So moving on. Stage 1 is to determine if the company is suitable for the defensive investor or the enterprising investor. Remember, the defensive investor is one who is not willing to do a ton of research into their investment opportunities, but they do want to look at individual stocks. So they have a stringent set of requirements. First of all, the market cap has to be over $2 billion. This one is well over that, so we pass. The current ratio has to be over 2. Here we have they have more current liabilities than current assets, so it fails on the current ratio. Earnings stability, it has to have positive earnings per share for 10 straight years, and here it does that, so we pass that requirement. Dividend record, it has to pay a dividend for at least 10 years, so we pass that too. Earnings growth, it has to have an increase in earnings of at least 33% in the past 10 years, looking at 3-year averages at the beginning and end. And here it just barely passes that, but it does pass, so it gets the point there. PEMG, that is the price to earnings Modern Gram. That's the price over that normalized earnings figure, and we get that has to be under 20. Here it is 9.12, so we pass on that regard too. And moderate price to assets, it has to have a book value of less than 2, and in fact it has a negative book value here. So technically it passes that, so we do get a 6 out of 7, and we get defensive score. Enterprising, the current ratio has to be over 1.5. It is not. and the debt to net current assets has to be under 1.1. It fails that too because, again, it has negative. The positive earnings per share, it has to have earnings stability for over 5 years. It passes. It has to currently pay a dividend. It passes that. And it has to have earnings growth over the last 5 years. It passes that. Now, it only has 3 out of 5 points for the enterprising investor, who, once again, the enterprising investor is somebody who is willing to do more extensive research into the individual company, so their requirements aren't typically as stringent. Here, it scores fewer for the enterprising investor than for the defensive investor, but because it is suitable for the defensive investor, it is suitable for the enterprising investor by default. If you are enjoying this, be sure to take a moment to like this video, subscribe to the channel, and download the free valuation calculator found in the link in the description and the comment below. Stage 2 is a determination of intrinsic value, and we take Benjamin Graham's formula from his book, The Intelligent Investor. And remember, Benjamin Graham is the one who taught Warren Buffett to invest. He is the father of value investing, and so it is important to follow some of his teachings. And I've updated this formula a little bit. It is value equals earnings per share times 8.5 plus 2 times the growth rate. I've updated it again to have that normalized earnings per share. But here we've got 2 variables to calculate, the normalized earnings per share and the growth. So let's get to that. Normalized earnings per share, again, is looking at the last 5 years, putting the most weight on the current year and the least weight 5 years ago. We get an EPS MG of 3.24. And then we take that from 5 years ago to calculate the growth. We get total growth between those 5 years of 46.4%. Divide that by 5, we get the average growth over the 5 years of 9.28%. And then we have a safety margin here. It is important not to overestimate your growth ratio because that is a key variable in this formula. If you overestimate, you will have a grossly overestimated value. So we have a safety margin at that point, and we cap it at 6.96% here. Now, plugging in those variables of earnings per share of 324 and growth of 6.96%, you get a value of 72.58, which, as you can see on this handy chart, is way more than the current price. Or down here on the bottom left, you can see Modern Graham Opinion, the price is $29.53, which is only 40% of the intrinsic value, so it gets an undervalued opinion there. A few other things to note. Net current asset value would be a floor to your value, but here it is negative, so it does not apply. Then a Modern Graham value based on 3% growth would be $46.94, or based on 0% growth, it would be $27.52. Now, if you put the market price, the current price in value, and you solve for growth, you get that the market is implying a growth rate of 0.31%. So another way of looking at this is if you think the company will grow more than that in perpetuity, then the current price is undervalued. If you think it will grow less than that, then it would be overvalued. It's just another way of thinking about this formula and looking at things. Coming down here, we have the Modern Graham grade, where we give points for different things so that it is a little bit easier to compare from one company to another and taking a broader view beyond just this one calculation of value. We get 2 points for being suitable for the defensive investor, 1 point for being undervalued, 0 points for trading, or it's not trading below its Graham number. We'll talk about that more in a minute. The dividend growth it's not a dividend aristocrat where it hasn't grown its dividend consistently. So we get 0 points there. We get half a point for having a good dividend yield, half a point for trading at below its industry average price to earnings ratio, and 0 points for trading below its net current asset value because it's not. And so we get 4 points in total, which according to the chart gives it a B+ rating. Stage 3 is further research. If you've gotten to this point and you have determined that the company is suitable for your portfolio and your individual needs, then the next step is to do further research and decide if it's a good fit for you, especially. And so, a few things to help you with that. We have the net current asset value. Normally, this would be a floor, and that is it's not an, it wouldn't apply here because it's negative. But it's a good number to remember is the net current asset value formula. It's what the company could give to every shareholder if it took its current assets and paid off every single liability. That's what would be left. Here it is negative. So again, it doesn't really apply. The Graham number formula is another way of looking at those defensive investor requirements. But here, because it has a negative book value, the Graham number is 0. So it's not very useful in this situation. But normally it can be. The price to earnings ratio, again, is 9.12. Current ratio is 0.69. Price to book value is negative. The dividend yield is 3.51%, and it has 7 consecutive years of dividend growth. Moving on to stage 4. If you've gotten to this point and you've decided that you want to move forward, then it's time to look at the chart to do a little bit of technical analysis to determine if it's a good buying time. We never want to base our value on the chart, but it can be useful for trying to maximize our profit. This is where enterprising investors can really dig in. They can be looking at many different companies, and they can use this trading to try and maximize their profit. You have to be much more active in order to make that work well for you. But looking here, we are at the daily chart. And what I like to look at is I like to look at the movement in the price. You can see that it's kind of hit a resistance level at about where I'm at here, where it can go back here and go back here. And so you know that at about 30.50, I'd say, or when you approach that 30.50 range, that is where it will hit a lot of resistance. But on the other side, it has a bit of support around the 29 mark and even more down at about 27. So there are 2 spots there. And then down here, you can see the relative strength index. This tells you whether the company is overbought or oversold. And you can see up here, it hit a pretty high mark. And then it came back down as it tried to reach that equilibrium again. The red line here is a moving average, and the blue line is a moving average as well. And those are just helpful things that can kind of help you see that. Right now, it seems like it is in a fair price. I like the market thinks it's a fair price. It might see movement as well. I'm not sure which way it will go. I think there's more downward pressure right now because that moving average on that RSI is on the higher end. So I think it would be coming down a little bit further. So I'd keep an eye on that. But again, that is something that you can look at. So now if you've enjoyed this, be sure to click on the video on the screen now. It will take you to another valuation that you will find useful. Thanks for watching, and I will catch you next time. Take care.